The truth is, wealthy individuals know how to play by the rules of the tax code to minimize their tax liability. And you can do this too. This isn't about tax evasion or anything shady. It's about understanding the rules and using them to your advantage. This is the Better Life Podcast, where we talk about real estate investing, building wealth, and all in all living a better life. My name is Brendan Turner, and I've spent my life investing in real estate to achieve financial freedom. And alongside my co-host, Mr. Cathcart, we want to help you do the same. On the show, you're going to hear from world-class guests who have been handpicked to help you level up your investing, your leadership, your goals, your habits, and more to become the very best version of yourself. So join us as we explore the habits, the actions, the beliefs that it takes to build wealth through real estate investing without losing your soul.
We set our sights on a better life.
You know, one of the biggest mistakes I made early in my real estate business was thinking I could do everything myself. I mean, I was the guy out there analyzing deals, managing contractors, taking phone calls, handling everything. My calendar looked like a war zone. Can anyone out there relate? That is why I'm pumped to tell you about HireTrainVA.com. So these guys find top-tier international talent specifically for real estate investors with a selection process that's so intense, only 1% to 2% of applicants actually make it. You can literally pick from their draft board of top virtual assistants and start scaling faster. And the owner, Valentina, she was actually a guest on this show back in episode 42. Every successful entrepreneur I know uses virtual assistants. I mean, I've got over 20 across my company. So hey, if you're ready to get out of the day-to-day and hire top-tier talent for a fraction of what it would cost you in the US, go to HireTrainVA.com/betterlife and tell them I sent you for 10% off. Or if you just go to my Instagram and DM me the word delegate, I'll send you their list of 100 tasks that any VA can tackle for you and give you a better life. Seriously, do it. You're gonna love it. Hey, so last year I paid nothing in federal income taxes. Same with the year before that. And the year before that. And no, it's not because I made no money. I actually made millions of dollars, but I've learned the secret that only the rich used to know about: how to pay little to no federal income tax. And it's totally legal and legit. And not only legal, it's actually encouraged by the United States government. That's right, the government actually wants me to pay less in taxes. Now, does that sound too good to be true? Well, that's the topic for today's video. So if you're ready to learn, grab a notebook, grab a pen, take some notes. Don't just listen, learn, and prepare to save a lot of money on taxes in the coming years. Now, I don't want this to be theoretical either. By the end of this video, you're going to have a bunch of actual, real, tangible steps that you can start to implement right away in your life to reduce or eliminate your tax bill. And by the way, in case you don't know who I am, my name is Brendan Turner. I am an active real estate investor. I've got over $1 billion in assets under my belt, which is more than like 13,000 some units. I'm also the author of a bunch of real estate books, including the book on rental property investing, which is the #1 best-selling real estate book on Amazon for the past 7 years. That's me. But let's talk about you and taxes, because you don't want to pay them anymore. I don't blame you. Let's get you out of it. I totally understand that. So taxes are one of actual life's biggest expenses for most people. Yet some people, like the wealthy, seem to pay way less than the rest of us. Now, people can get mad about that, or you can learn how to work it, right? Maybe you've heard stories of people like Donald Trump or Jeff Bezos who pay almost nothing proportionally in taxes despite making millions or billions of dollars. Are they doing something illegal or unethical? Actually, no, not at all. The truth is, wealthy individuals know how to play by the rules of the tax code to minimize their tax liability. And you can do this too. This isn't about tax evasion or anything shady. It's about understanding the rules and using them to your advantage. So let's dive in. First, let's get one thing straight. The tax code is not just this set of laws designed to make your life miserable. It's actually a guide. So the tax code exists to encourage or discourage certain behaviors. Think of it like a giant instruction manual from the government telling you how to act if you want to pay less in taxes. For example, the government wants people to own rental properties. Now, why would they want that? Because housing is essential for the hundreds of millions of Americans, and the government doesn't want to be in the business of building homes for everybody. That's not what they want to do. So they incentivize private investors like you and I to do things, to build real estate, to own real estate by offering tax breaks on things like rental income. Now, rental properties can actually produce lower taxable income because of the way that cash flow is taxed and the deductions that are allowed for on rental properties. I'm going to explain more of that in detail in a little bit. I'm going to give you some tactical stuff because there are some really cool loopholes that you can use with real estate to reduce or eliminate your taxes. But this principle applies to other areas outside real estate too. I mean, I'm a real estate guy, but this applies to a lot of things. If you invest in clean energy, you create jobs, you start a business, there are tax breaks and loopholes available to encourage those activities. Now, the wealthy have really mastered this playbook, which is why they seem to pay less in taxes than the average person. So, how do the rich avoid taxes? Well, let me give you 4 big ways. First, one of the most significant strategies they use in building wealth is something called unrealized gains. You may have heard that in the news. So take, for example, a wealthy person who buys $50,000 of a stock. Now, over time, that stock climbs from $50,000 to $500,000. Now, that increase of $450,000, now that is added to their net worth. They're $450,000 richer because of it, but they don't pay taxes on that $450,000 unless they sell it. The same is true for people who own a business. Their business might be worth $1 billion more than they got into it, but if they don't sell it, they're not going to pay taxes on that gain. Now, you might be thinking, well, who cares if you have all that added net worth if you can't spend it? But here's the secret. You actually can. You can borrow against that equity. Now, a really good example of that is found in real estate, but it also does apply to stocks and businesses and pretty much any other asset that you own. But let's just use real estate as an example. Let's say you own a rental property and it goes from $500,000 in value over time to $1.5 million. You made $1 million bucks. But if you don't sell that property, you don't pay taxes on it, but you can take out a new loan against that $1 million. You can borrow most of it from a bank at very low interest rates. And guess what? You do not pay taxes on a loan because it's not profit, it's debt. The property's cash flow should more than cover the additional loan payment, and you just make money. You just get a big chunk of money. This is one of my favorite things in the world about real estate. As it goes up over time, you can just refinance continually every few years, taking a larger loan on each one. Pay no taxes because it's not profit. Now, I don't need to sell my rental properties ever because I can just keep borrowing against them and pay no taxes over and over. In fact, here's a real life example of how that works. So the week my daughter Rosie was born, it was 8 years ago, I bought a cheap fixer-upper rental property. I used a hard money loan to buy it, and I fixed it up with that. And then once it was all fixed up, I put it on a normal mortgage. But I set up the payment so that it would be fully paid off by the time she goes to college. So it was on an 18-year loan payoff plan. So when she's 18, that property will be worth more than $500,000 bucks, but we're going to owe nothing on it because we paid it off. Now, at that point, we could sell the property, take all the money, pay taxes, pay for her college, but I don't like paying taxes. So instead, we'll refinance it. Once the loan's down to zero, we'll go get a new loan for whatever it costs her to go to college, and plus whatever profit we want to pull out, and her college will be paid for from that loan, tax-free. Then we'll pay that new loan off over time, and she can use that someday in the future for her own retirement, all from one cheap fixer-upper rental property. All right, on to a second way people avoid paying taxes, and this is actually how I practically paid nothing in taxes: deducting real estate depreciation. So when the wealthy invest in rental properties, the tax code allows them to deduct the depreciation of those properties. I'll explain that in a second, even though the properties often appreciate in value. Okay, so what does all that mean? Well, over time, a property breaks down. A roof needs replacing, windows break, water heaters need to be replaced, carpet needs, all that. So the house itself is falling apart over time, at least on paper. So the government requires that you deduct. They require you deduct a little bit every year for 27 and a half years, but not the land, just the house, because land doesn't break down. So over 27 and a half years. Now, why 27 and a half years? No one knows. It's just the number the government randomly says that's the life of a rental property. But then the rich, and you can do this too, we do something called a cost segregation study. Now, these studies, which can be done for a few $1,000s from a qualified cost segregation firm, they take the property and they say, well, yeah, the house is divided over 27 and a half years as a whole, and we can deduct that. But if we segregate or break apart each component, we can depreciate each part of the house separately at a shorter period of time. So why does that matter? Well, because the whole house depreciates over 27 and a half years, but flooring can be depreciated and deducted over 5 years, as can most other individual components of the house. So a cost segregation specialist says, hey, this isn't just a house.
It's 2,000 square foot of flooring. It's 45 windows. It's 5,000 square feet of baseboard trim. It's 5 ductless heat pumps. You get the idea. So instead of going 27 and a half years, we can write off huge parts of the house in smaller time frames, like 5 years. And by doing this tactic, you can dramatically change the amount you can deduct every year. So let's say $10,000 per year that you get to lose on paper to $100,000 a year you can lose on paper. That's a huge paper loss that can offset other forms of passive income like cash flow, but can you offset your W-2 income? Maybe. So if you play the game right, which means that either you or your spouse becomes an actual real estate professional, which the government has some hourly requirements like 15 hours a week. If one of you is a real estate professional, you can take that paper loss from your real estate depreciation and it can offset your active income, allowing you to pay nothing in taxes. Oh, I love real estate. But one final point about this. Someday, when you sell the property, the government is going to require that you pay back all that depreciation, unless you do tactic number 3 in how rich people avoid taxes, the 1031 exchange. So the 1031 exchange is like a real estate trade-up program for investors. So imagine you own a rental property and you want to sell it, and you want to use that money to buy a bigger or better property. Well, normally when you sell a property, you got to pay taxes on the profit you made, plus pay back all that depreciation we just talked about. But with a 1031 exchange, the IRS says, hey, if you're reinvesting that money into another property, we're just going to let you delay paying those taxes. So here's how it works in simple terms. First, you sell your current property. Second, instead of taking the money, you cannot touch the money. That money goes into a special account managed by a middleman called a qualified intermediary. So basically, it's somebody who holds the money for you. There's a lot of companies that do this so that you don't touch it. And then third, you buy another property and you use that money to buy another similar property. Now, usually it's another investment property within a certain time frame. The key to the 1031 is a time frame. It can be a doozy. And the result is you can just keep growing your real estate portfolio and your wealth without being hit with taxes on the profits along the way. It's like hitting the pause button on your taxes while you upgrade to better properties that produce more cash flow and more wealth for you. Now, eventually, you might have to pay those taxes if you sell without reinvesting. But until then, you can just keep rolling your gains into new deals, and maybe eventually you'll get so rich it won't matter. Or you can eventually just roll all of your profits into some super passive like shopping mall or something like that, and you can live on just massive cash flow until the day you die. And then the tax bill will likely be totally wiped out for your kids. That's awesome. All right, fourth strategy rich people use to avoid paying taxes. The wealthy maximize the use of tax advantages like accounts, like a Roth IRA, a health savings account, which is called HSA, or like 401ks. So these accounts allow their investments to grow tax-free or tax-deferred, reducing their taxable income, like today, while sheltering wealth in the future. So these accounts are essentially a legal way to shield wealth from the tax man. Now, here's a great real-life example of how one billionaire used these accounts to make billions tax-free. So 1999, Peter Thiel, you've probably heard of him, he opens a Roth IRA and he purchased shares of a little company that he was part of called PayPal. Less than a penny each. Shares that were super cheap because it was the early stages of his own company. So he buys these in his Roth IRA, and it allows for tax-free growth. And so then the rapid growth of PayPal meant those penny shares inside of Thiel's like Roth IRA became worth millions after the company went public in 2002. He then reinvested those gains into other high-growth companies like Facebook and Palantir. He compounds his wealth over decades, and all the while he stays within the rules of the Roth IRA. So by 2021, his Roth IRA was worth an estimated $5 billion, completely tax-free. Now, that strategy highlights the incredible power of investing early in companies with an IRA or real estate and letting that tax-free benefit of a Roth IRA work over time. It shows how even a small initial contribution into Roth IRAs can lead to extraordinary outcomes with some smart planning and a little bit of luck. But this isn't only for the rich. Like, did you know that you can do an IRA or Roth IRA, but did you know about the solo 401k? The solo 401k is a great retirement plan for self-employed people or small business owners, which you can become, people who have no employees except for a spouse. It lets you contribute as both an employee and employer, which means you can save much more compared to other retirement accounts. You can put a lot more into it every year. So in 2024, you can contribute up to $22,500 as an employee, or I think it's like $30,000 if you're over 50. Plus, you can put 25% of the business profits as the employer. Now, if that's a total limit of $69,000 a year, you can choose to save pre-tax to lower your taxes now, or Roth contribution for tax-free growth and withdrawal later. Now, Solar 401k gives you a lot of options to borrow against that, and you can invest in things like real estate or other alternative assets inside it. It's flexible and powerful, and it's great for entrepreneurs to save for the future while enjoying tax benefits now. Hey, was this helpful? If so, smash that heart button below the video and let the internet know it's valuable. And if you're not already subscribed to my channel here, Beardy Branding, click that subscribe button if you want to learn and be good at building wealth without losing your soul.
And that, my friends, is the show. Thank you for tuning in. And hey, before you go, if you enjoyed this episode or if you just enjoy the show in general, please consider leaving us a rating and review wherever you listen to podcasts. We really do value your feedback, and we read the comments. We make future decisions about topics and guests and everything else. Plus, it helps us reach more people, and the more reviews we get, the more people hear it and watch the show and share it, and it's awesome. Last but not least, please head over to social media. Consider befriending me, following me, subscribing to all that stuff at Better Life and my personal page at Beardy Brandon, especially over on Instagram, YouTube, and really everywhere else. So thank you again for listening. I'm honored that you would bring me along on your journey toward building wealth through real estate investing without losing your soul. Now, this show is about living a better life, but if you want my opinion on what it takes to live the best life ever, just go to abetterlife.com/best life to hear some of my views on life and spirituality. I think you'll like it. abetterlife.com/best life. With that said, thanks for listening to the show. We'll see you next week.